Retail investors are finally jumping on the U.S. stock bandwagon. Well, they might not be jumping. They're perhaps hopping a little lightly, if you will. For the first time since the so-called flash crash in May, investors put more money into domestic stock mutual funds than they took out. Bloomberg's Zahra Burton has more on what this could mean for the market rally. Zahra, it's not necessarily a big move, but it's significant because it hasn't happened in so long.
It is significant, and as you pointed out, not and I like that phrase that you used, hopping. But the fact that everything is now turned positive, this is perhaps now the latest piece of assurance that the bulls really needed, that this year's market rally will remain intact come next year. If you look at the Investment Company Institute and what they said yesterday, after 33 weeks of outflows, $335 million have now flowed into domestic equities, coming at the expense, of course, of bond funds, which have now seen a third straight week of outflows. Now, even through that 22% rally in the second half of the year, investors still withdrew about $62 billion from U.S. stock mutual funds over that time. But as Barclays strategist Barry Knapp actually told me, money follows price, and the pension and the retail investors are probably going to be last to the party. Now, if you think that's bad, he says not necessarily so. In fact, he says it's completely normal throughout various recessions that investors would be infatuated with fixed income funds. But 2 years into this Great Recession, the economy is improving, risk appetite is coming back, and with these retail investors now getting involved in equities, Julie's, he's actually forecasting an almost 13% rally in the S&P 500 by the end of the next year. And we all know he's not alone.
No, he is far from alone. In fact, I think he's kind of in the middle to even a little bit low in the pack there. Thanks a lot, Zahra. Appreciate it.